Hey everybody, Don Winter here. We have lots of people jumping on right now, so we'll get started in about 30 seconds. Thanks for jumping on for today's webinar on where DLP will find opportunities in 2019, and in a broader sense, talk about where we're at with the real estate cycle and where the opportunities are in general now and in the upcoming couple years. So looking forward to this webinar, and we'll give it about 15 seconds and get rolling. All right, so again, welcome. My name is Don Winter. I'm the CEO and founder here at DLP Capital Partners. I'm going to be talking about finding investment opportunities here in 2019, and really excited about this webinar, this training, sharing where we see the real estate market, how we feel we can capitalize on it while mitigating risk now and through the next cycle. So, quick disclaimer there, typical stuff. This is not a solicitation. All right, so quick bit of us. This is your first time with us, which looking at the list of people on here, there's some names I don't yet know, so some people here with us for the first time. Our investment principles are no losses to investors ever, period. Consistency in our returns, invest in what we know at a deep level, and then generate as high as returns as we can, not jeopardizing those first three principles. So it's really important to understand how we think about risk and how we think about investing to better understand how we look at 2019 and beyond in terms of how we go about assessing the market, making investment decisions, laying out our strategy and direction. Because for us, having losses to investors is not possible. It's not allowable. It's never happened in our 13-year history, and we're not going to start through the next cycle. And we also have to be able to generate very consistent returns. So in order to do both of those things, we feel we need to know what we're investing in at a deep level. And then by doing those things well, we've historically been able to generate a very high return to our investors and certainly expect to continue to generate very strong returns to our investors. So a quick bit about me. This is actually my 13th year in real estate. I've closed more than 11,000 real estate transactions for over $1.5 billion with our team, including acquiring more than 1,200 apartment communities, commercial assets, homes, et cetera. And then I've been ranked as one of the top 15 real estate professionals in the U.S. each of the last 5 years. And I am the founder and CEO of each of our family of companies. Currently, along with our investors, own over 9,200 apartments and homes in our portfolio right now. In addition to the 3,000 to 4,000 apartments and homes we have loans against as a lender through direct lending partners. This is the executive team who drives results here across the family of companies here at DLP, who really ensure our ability to execute on the strategies that we're going to talk about here. And then real quickly, I'll mention Bob Peterson and Barry DeGroot. So Bob Peterson, our Chief Financial Officer, and Barry DeGroot, our Chief Legal Counsel, are both partners here in DLP Capital as well. All right, so before I tell you how we're going to capitalize on 2019, what our investment strategies are, first I want to talk to you a little bit about my view of where we stand in the real estate market, what's going to happen here in 2019, and then also touch a little bit on beyond 2019. So here in 2019, multifamily real estate will remain the #1 most sought after asset class by far, meaning it's the asset class where the largest amount of money is flowing to, where the largest percentage of the institutional capital going into real estate is moving into. There's already been many billions of dollars of capital. Last number I heard was $36 billion of capital raised to be deployed into multifamily assets here in 2019 that are already raised, committed, but not yet invested. So there's a ton of money, a ton of dry powder waiting to invest, already raised and committed. And these institutional groups only get paid if they deploy the money. So they're under major incentive to find ways to deploy the money within multifamily real estate. In most cases, the vast majority of that capital that was raised was actually raised for the Class B multifamily space, which will remain the #1 sub-asset class, meaning out of Class A, Class B, Class C. Class B is the largest, most sought-after asset class right now for capital to be deployed into. Tens of billions of dollars are already raised, waiting to be deployed into Class B real estate, which in general, first time you heard that term, is typically 1980s, 1990s, early 2000s built apartment communities, typically much lower rents than the brand new products, and not nearly as many or as nice of amenities as a brand new Class A property. And the reason so much money is moving into Class B, and why, you know, all the quote unquote smart money coming out of Wall Street has decided on the Class B space as the place to go into, is because everybody in general believes that we are in the 8th or 9th inning of this real estate cycle, and that there will be some sort of recession coming soon, and believe that the Class B space is going to fare best due to its ability to generate great cash flow. It's better, much better cash flow generation at the pricing of Class B than compared to Class A. And also because in general, the apartments are more affordable, monthly rents are lower. It's going to in general do better when there's higher unemployment, when there's less certainty in the market, when we're in a recessionary environment. So that's been proven, and the large capital is seeing that and realizing that's the place to go to put your money into a safe place where you can generate good cash flow. So with that said, that brings to that third bullet point there, which is cash flow is king and where the vast majority of capital is flowing. So even within Class A, Class B, Class C multifamily, even when you look at office, retail, industrial, self-storage, any other asset class in real estate, and then even outside of real estate, cash flow is what everybody's after right now. And that's why groups are going to multifamily, and why they're going to Class B is for consistent cash flow, even as we go into a recessionary environment. But in all asset classes, the money's flowing to the properties that are stable and are producing really good cash flow. Properties that are not stable, that don't have good cash flow, are going to sell at a discount because capital wants cash flow. So the values are going to remain very high, especially for cash flow assets, because there's so much money already raised. When tons of money, when there's more demand, more capital raised than there could possibly be deals done, that's going to keep values high. And because this capital is already raised, it's already committed, it has to be deployed, these analysts and underwriters are going to have to find ways to justify essentially any pricing in order to deploy that money. So they'll go and justify by assuming that rents are going to keep growing at really high rates, by assuming that they're going to be able to exit the properties at really low cap rates. They're going to find ways to justify paying, frankly, in my opinion, too high of prices in order to deploy the capital, which is why in 2019, despite a lot of talk about towards the end of the market and market softening and so forth, values will remain very high, especially in assets that are producing cash. And I believe 2019 could very likely be the high watermark in terms of values, meaning that values will soften and go down into 2020. And I could be a little early. 2020 could end up certainly still having pricing that exceeds 2019. That's certainly possible. I certainly hope that's the case. But I would expect, if I had to bet on it, I would bet that 2019 marks the high water mark, and that we'll see pricing soften and values go down in 2020. If not 2020, certainly 2021. And that doesn't mean it's going to be the high water mark forever, but through the next cycle. And we'll see values soften. We'll see financial markets tighten up, meaning demand will decrease, supply will increase, and values will soften. In 2019, I expect interest rates will remain stable. That's what most of the quote-unquote experts now believe. 6 months ago, everybody thought that rates would continue to climb through 2019, but the Fed has backed down from that and has really realized and could have put themselves in a corner that they can't keep raising rates, and they've kind of have to keep them stable now, is what most of the, again, quote-unquote experts believe, and what I believe here from all the conversations I've had with a lot of top people at a lot of large financial leaders. And then I also believe rents will continue to grow steadily in most of the markets that we here at DLP invest in. It doesn't mean every market in the country is going to see rent growth, but most of the markets, most of the Southeast markets where our properties are located, we believe will continue to see steady growth. In general, we think we're going to see 2 to 3% rent growth in 2019 compared to 4 to 6% that we saw in 2018. So we're still going to see revenue growth, certainly a little bit less than what we saw in 18 we expect, but we're still going to see strong revenue growth, especially in this Class B space where there is no new supply and increasing demand for the apartments due to population and job growth, which is happening in most of the markets we're in the Southeast. In addition, in 2019, we expect to see supply remain constrained in most markets, meaning both supply in terms of deals available for the investors to invest into, which is, again, demand exceeds supply, and then also supply in terms of apartments available compared to the demand for those apartments from residents. And again, I'm talking specifically here in Class B, but even in a lot of Class A market, a lot of Class A products have have more demand than supply. But there are some top markets, the places where all the big hedge funds thought were the top markets to go into, which many cases were the Austin, Texas's, Dallas, Texas, Atlanta's, Miami's, et cetera, of the world, where there's been tons of brand new product built over the last decade. Many of those markets now are facing an oversupply. There is more product than there is demand. When that happens, you're going to see rents decline and occupancy decline. In most cases, both. You'll see decline, at least certainly one or the other. So we think a lot of the larger MSAs are going to see some challenges in the Class A space, especially since a lot of these markets still have a ton of properties coming out of the ground right now. Have a lot of projects in development that there's going to be, if there's not already, an oversupply of Class A in a lot of markets, a lot of the top markets, I should say. We also expect here in 2019 that we're going to see real estate operators, both single-family fix and flip operators, single-family landlords, and multifamily active investors remain very, very active, searching for deals, doing deals, looking for distressed opportunities here in 2019. The market's going to remain very active, and we'll see close to historic volume of investment transactions done here in 2019. We also believe that the talk and the rhetoric around the next market correction will continue throughout this year, and we'll continue to see an increase in fear and concern within financial markets, banks tightening up especially on development or construction projects, as people are concerned on when we're going to finally go into this market correction or recessionary environment that many have been talking about for 2 or 3 years now. And again, 2019 will likely be the high water mark in pricing for possibly the next 4 to 6 years, or at least very close to the high water mark in terms of pricing. And then beyond 2019, we think the market will have a pricing / valuation correction. So maybe it'll extend all the way out to 2021 before we see a correction. I expect it to come sooner, but could see market remaining strong into 2020 because there's so much demand. But would expect a lot of this start happening in 2020. We expect to see financial markets tighten, and that to cause liquidity issues. We think that those liquidity issues will create a lot of investment opportunities and distressed opportunities, especially in assets that are not cash flowing. But we also believe that the lack of supply of affordable housing will provide shelter, meaning that we're not going to see a lot of the different markets that struggled, especially in the single family home markets in 2008 type downturn. A lot of markets had an oversupply of housing. There's a lot more construction that was happening in the last cycle. In most markets today, there is such a lack of supply for affordable housing that we think that's going to shelter and limit the type of downturn we saw in the last cycle. And then a quick quote that I got to spend a little time with Sam Zell, who's arguably, in my opinion, not arguably, he is the greatest real estate investor, at least in my generation over the last 20, 30 years. And I got to see him and spend some time with him in Boca Raton about 3 weeks ago. And he said, which stuck with me, you do not invest in the market, you invest in deals. There are always great deals. And I just want to highlight that because I just, gave a little bit of doom and gloom here. What's going to happen? There's going to be a market recession environment. Probably doesn't surprise most of you, but that doesn't mean that there's not deals to be done. That doesn't mean that that's going to slow us down and being able to deploy capital, being able to invest. There's always great deals. There's always distress. There's always volatility that creates opportunity. And if you can capitalize on deals, you can do well despite any market, because we're not buying the market, we're buying deals. And then also want to highlight the fact that this has been proven through a lot of studies that over 70% of wealth is created during the 10 to 15% of the most turbulent recessionary environments over the last 100 years. So in the 10 to 15 years in the last 100 years where we've been in the worst recessionary environments is when 70% of wealth has been created. So distress does not mean that there has to be losses, or that's a bad thing for investors, especially if you invest in ways that capitalize on distress and volatility, which is exactly how we invest here at DLP, which is why for our investment strategies, we're, I don't like saying it this way, but we're excited for volatility, for change, for distress. We certainly don't want to see, a market correction and see people in distress and unemployment and things like that. But from an investment standpoint, distress and volatility are good things for us. So let's talk about what we're going to do with this 2019 market and how we see the market here today and how we're going to capitalize on it here in 2019. So first thing we're doing here at DLP that we're continuing to focus on, it's not a new thing that we're focusing on, but we're continuing to focus more so and actually expecting to do 200% of the volume we did last year in short-term bridge lending. So we do 6 to 12 month loans, first position loans with low loan to value and low loan to cost. We lend to strong operators. We're continuing our focus on going upstream, meaning working with bigger, larger, more stable, bigger balance sheets, more liquidity investors. That's our big focus. We continue to improve the quality of our operators because we believe the larger and larger, what I mean by that are larger entrepreneurial private investors. We're not talking the big hedge funds, but the private entrepreneurial groups, the groups more like DLP, the groups who run an organization of 30 or 50 or 100 employees and own $50, $100 million or $200 million in real estate and are vertically integrated and do their management in-house. And so for those types of operators, we believe are the guys who are going to capitalize on the next market cycle and are going to be doing more deals, not less deals, when there's a recession environment, unlike the smaller operators who are going to struggle with liquidity and struggle with execution as the market softens. We like this strategy, knowing that a market recession is coming of some sort, because by lending short term, it limits our long-term market exposure. If we were writing 10-year loans and the market goes through a recession for 4 or 5 years, we could be in a situation where our collateral is declining in value and we get close to or get upside down if there was a major decline in values. But by keeping our loans very short, that avoids that from happening. And then we're also remaining very focused in lending against investment housing with a focus on affordable housing. The same place we invest as an operator at equity, we believe the affordable housing space is going to do really, really well due to the lack of supply. Occupancy remains strong, rents will remain strong, cash flow remains strong, which puts us in a really good position as a lender, lending against strong cash flowing assets. The second strategy we have, which again is not a new strategy, but a strategy we're focusing even more on, is structured preferred equity into the Class B multifamily space. And what I mean by that is what we've been doing here over the last 2 years and doing more of. About half the deals we did last year were preferred equity deals with other real estate operators, where we're putting our money here as DLP into the asset in front of the partner, meaning we get our cash flow first, we get our money back first, we get our return first. So by investing in Class B affordable housing that's going to fare very well in terms of high demand, low supply, great cash flow through a recessionary environment. In addition to that, by structuring our capital to be in front of usually, a couple $1 million of common equity that further insulates us from any risk in, market values declining or even cash flow issues. So it's a great way to mitigate our risk and how we structure our capital within what we think and many others think is the best asset class to be in, by structuring our equity as preferred equity. So we're going to expect to do an even larger percentage of our deals in this structure. Probably 2/3 to 3/4 of our deals here this year will be in a structured equity position. The next way we're capitalizing on the 2019 conditions, including the fact that, as I mentioned earlier, this will very likely be the high water mark in terms of values, is we're going to exit all of our lower quality, I shouldn't say all, but the majority of our lower quality assets, our Class C, smaller apartment communities. We're also exiting almost all of our single family rentals, which were always purchased for the purpose of selling at the high water mark. And we're also exiting most of our non-multifamily commercial portfolio, which is basically Class B office. And again, that was always, those properties were purchased with the purpose of selling at the high water mark. So, and then essentially we're selling anything that produces weaker cash flow, and anything that we don't want to have to own through the next market cycle, meaning if values do decline significantly, we want to exit anything that we don't want to be in a position to have to exit when values are lower, because we don't want to have to own it for the next 5, 7, 8 years. So we're repositioning our portfolio. We're selling off our smaller assets, our lower quality assets, our less consistent cash flowing assets, and continuing to focus on restructuring our capital to be more debt, more lending, as well as more structured equity into the Class B space. And then the assets we are not selling, we're focusing, if we haven't already done so, making sure to lock in our assets into long-term fixed debt so that when interest rates do rise or when valuations decrease, meaning appraisals will come in lower and loan proceeds would be lower, locking into fixed interest rates now at today's low rates and high valuations. So we can maximize our leverage also by locking into great leverage now at low interest rates increases the value of the property, because if we lock in a 10-year loan at 5% interest rate today, and even in 2 years, if we decided to sell that property and rates are at 6%, 7%, that asset becomes even more valuable because all of our loans are assumable, meaning the borrower can assume our debt and keep the low interest rates, which increases the value of the assets if interest rates rise. And by also locking in, of course, with low interest rates, we're maximizing our cash flow now and through the next market cycle by having our debt locked in. So that's a big focus for us here in 2019 on all of our assets that aren't already on long-term debt or we're not exiting here in 2019. And then the final strategy that we're focused on here is a new strategy for us, which is essentially investing in Class A assets at Class B prices. And to speak a little bit further on that, as I mentioned a little bit earlier, properties that have strong cash flow, or in other words, strong debt service coverage, meaning the income coming off the property more than covers the debt service, those properties are in high demand. The values are going to be really high. There's lots of capital trying to buy those deals. But the properties that don't have good cash flow are hard to finance. And most of the capital out there, most of the institutional capital ignores properties that aren't cash flowing well. They want cash flow. That's what they're trying to lock in for. They can lock in their long-term debt and buy cash flow. So properties that are not yet producing positive cash flow, and that's an important point, not yet producing strong cash flow, is where we think there's a lot of great opportunities. And we think that there's going to be a lot of opportunities in Class A properties. So an example of that is as I have there, is the most common example will be brand new Class A properties that did not yet stabilize in time for their construction loan to mature. So I'll give you an example. We have a deal in a market in actually Mississippi that was a brand new property that was went into development in 2013 or 14, went into construction into I believe in early 2017, and their loan was due to be paid off the end of 2018. And their business plan was then to refinance into long-term agency debt. But because they took them longer to complete the property, they went over budget, et cetera, by the time their loan came due, they only had about 40% occupancy. So the property didn't cash flow. So because it's not cash flowing, they can't get a loan on it. A lender will not give them a loan without debt service coverage to cover the loan payments. So they can't get a permanent loan. The current bank, which is a regional bank, won't extend their loan because they're worried about where we're at in the real estate cycle and don't want to be stuck in a construction loan. So they're putting the borrower into default because the loan's not paid off and they can't get a permanent loan. So this borrower is stuck. And so we've been negotiating to buy that property. They built it at about $143,000 to $145,000 per apartment, which is actually a really good price. And we've been negotiating to buy it at $118,000 per apartment, which is close to a 20% reduction in the construction costs. So essentially, we're going to be able to buy this asset, assuming we complete this deal, at what will be over an 8 cap rate once we finish the lease up on the property, and really buying it at a Class B price. And we think there's going to be a lot of those types of distressed opportunities where operators can't get their permanent financing because they're not producing cash flow and their loans are coming due, or they have some reason they need to get out because the property's not producing cash flow and they get stuck. And in markets that have been struggling with Class A space to lease up because of potential oversupply, create some unique opportunities. And we have to go into those markets and study and understand if there's a lot more product coming where there's going to consistently be an oversupply issue or not. And this specific property that I was just talking about has no products in construction or development in the entire market, meaning there'll be no new supply, and there's lots of demand coming into the market. So it creates a really unique, attractive opportunity. That's an example that we think we're going to see more of here in 19, as well as probably into 20 as well, 21 even, of these types of assets, which we think is a pretty interesting play. So with that said, those are how DLP is going to capitalize on this. I'm going to quickly just run through our investment funds that focus on these strategies, and then I'm going to open it up to questions here. So first strategy is our DLP Income and Growth Fund, which makes short-term bridge loans, as we talked about as the first strategy. It makes short-term bridge loans to real estate investors that DLP lends to, as well as make short-term bridge loans to DLP on these strategies that we just talked about that we're buying, which is one of our advantages, that if we come across a property that's hard to get permanent financing on because it's not yet stabilized, we can come in there with the DLP Income and Growth Fund, fund ourselves that loan, stabilize the property, and then get our takeout financing. The DLP Lending Fund is our fund that just makes loans to third-party borrowers. It does not lend to DLP. And both of these funds have a 10% preferred return, meaning investors get a 10% preferred return before we earn anything. They both have an 11% targeted return. They both historically generated over a 12.5% annual return net to investors. And looking at this as 2019 into 2020, we expect both of these funds generate high 12s to low 13s % returns net to investors. Then we have the DLP Preferred Return Equity Fund, or PREF fund. This is the fund that's available today that buys real estate directly. So this fund could very likely buy that Class A type of property we just talked about at Class B prices. This fund makes preferred equity, structured equity investments that we talked about with other operators, where our money is, every deal in this fund, the money is in a preferred position to common equity, sheltering the fund in an asset class that's already well sheltered and well positioned for the next market cycle. We further insulate ourselves by being in a preferred equity position. This fund's designed to produce 8% plus cash on cash returns off of rental income. And then at the end of the fund, in 5 to 7, 8 years, return back 1.5 to 2 times your original investment, including the cash flow. It's a tax advantageous fund due to depreciation, shelters you from tax. Then you can invest in our lending strategies as a note investor. This is our absolute lowest risk position here at DLP, where you're in the absolute first position to all other DLP capital. you can commit for just 90 days up to 5 years and lock in and get a fixed interest rate based on the amount of money you invest and the amount of time you commit. And then the newest fund that is finally almost live. Literally, as soon as we finish up here today, I have a call with the insurance company that we're Lombard International that we're opening this with. We're basically will be able to invest in our lending strategy wrapped within an insurance policy or an annuity. So if you have an existing insurance policy or annuity, you could roll out of what's called a 1035 exchange and take your money out of, essentially, some indexed funds or whatever you're in today and invest into our lending strategy, tax sheltered, or could even be a place to invest new capital or non-existing insurance money so that you can shelter your gains from tax by wrapping it within an insurance policy. So we should be live there by end of this quarter. We have a lot of demand for this. And then last item before I open it up to questions, since I know we have a good number of people jumping on and hearing us for the first time today. Sometimes when people hear our investment minimums, they hesitate on wanting to kind of test out working with us, wanting to start a little bit lower. And usually our answer is no, those are our minimums. Income and Growth Fund is our lower minimum at $250,000, and then $500,000 for the Lending Fund and Preferred Return Fund. So to help incentivize you to take advantage of these opportunities and sort of dip your toe in the water, we're going to cut our minimums in half between now and March 15th to make it easier for a new investor to dip their toes in the water and work with us. And you can go right to that link there, which we'll send out. I think just got put in the chat box as well. DLPcapitalpartners.com/promotion. And you can submit your information if interested, and then one of our investor success managers will reach out to you to talk further about our funds. And we'll also provide you, we have a full DDQ site, which gives you all of our past financials and details on all the funds I just talked about, our strategies, et cetera, allow you to explore and get to know us and our strategies and our track record better. So with that said, I'm going to go ahead and open up to questions. You can type those questions into the chat box, which some of you have already done so, which I will jump into here in a second. But feel free to go ahead and type any further questions into the chat box. If you're on Zoom or if you're on Facebook Live, you can type them in there, and then Kyle will, who's running the meeting, will mention those to me verbally. All right, so I'm going to go ahead and start tackling questions. All right, so Alan entered the first question here. So question is the structured preferred equity part of the DLP Lending Fund? No. So the DLP Lending Fund and the DLP Income and Growth Fund are only making first position or are only making loans to real estate investors. A lending fund, all loans are first position loans backed by real estate. Neither of the funds are making equity investments. The only fund that's making equity investments is the Preferred Return Equity Fund, which is designed to invest equity into real estate and get the benefits of depreciation as well. So awesome question. So I've got a couple questions here about the minimums. So the normal minimums, the lending fund is 500,000, income and growth is 250, 500, where you see them crossed off. Right now it's 250, 125, and 250, the numbers on the right in red. So awesome question. So I had a question here about the Class A strategy. So to specify here, there were a couple questions. I'll just try to explain this a little bit better. So what we're looking at here, and most part, this isn't going to be in the, which is one of the questions in the large, Houston's, Denver's, Atlanta's, the large top tier MSA markets where there's tons of supply and also tons of capital. These are largely going to be in secondary and tertiary markets where there's nothing wrong with the asset or the strategy or supply demand issue in the market. It's simply a timing issue, and that's often what creates. The funny thing is, what often creates I guess maybe it's not funny, but but it's often what creates the recessionary environment, and what creates distress is people worrying about distress and a recessionary environment. So the lenders often are what create the recessionary environment, because they get worried that we're going to go into a recessionary environment. So they tighten up the ropes and they won't extend loans. They won't work with borrowers. They stop lending they create illiquidity issues for operators, which then creates distress, which then, you know, starts the cycle. So it's interesting how it often happens, and it really always ends up happening that way, that it gets, well, fear creates the distress, and then the distress creates more fear, and it creates that cycle. So we're really looking at strong assets in good markets with the right fundamentals, but where there's really a timing issue being created by the financial markets. So great question. I hope I answered that correctly. So one of the questions is about any redemption fees. So yes, we don't charge any redemption fees in any of our funds. So in our lending fund, income and growth funds, one of the things that are really, really attractive with these funds are that you can redeem with 90-day notice. So we have 90-day redemption, and I apologize here, I realize I got some notes here on the screen here, but I have to do this so I can read the chat box. That's why I'm out of full screen right now. The funds have 90-day redemption notice in them. So you come in on day one, and on day two, something happens, good or bad, that you need liquidity. You give us 90-day notice, and we're going to make every good faith effort to redeem you within 90 days. And we actually have to stop originating loans if we don't. From a practical matter, typically how the conversation goes with investors who need redemptions is they come to us and say, you know, hey Don, or they go to Larry or one of our team members and say, look, I need some liquidity, or I need 100 grand out of my account, or I need to redeem my entire investment, et cetera. And then we say to them, all right, when would you like the capital? And usually, you know, we often will redeem in 2 weeks notice, or 30 days notice, or 45-day notice. We're very liquid because 1/3 of all of our loans pay off every 90 days. So we have a lot of liquidity. It makes it easy to honor quick redemptions for our investors. So there's no fees we charge, there's no penalties, there's no waiting periods or tie-ups. From day one, you can invest and redeem your investment 90-day notice. Our fund documents used to say we had a 1-year tie-up. We never actually used it. We never actually held anybody to a tie-up, but we removed it out of our documents. So we haven't looked at the documents in a year or so. That has now been removed, but it's nothing we ever actually implemented either. That's why we removed it. And we don't charge fees in any of our funds. And it's another important point to mention is, you know, when I show, and I'm going to go ahead and pull back into full screen, but as I show these returns here, you know, targeted annual return net to investor 11%, you know, 11%, 12%. These returns are always net to investors, meaning there's not a fee and expense, a dollar that comes out of these returns. They're truly net to you after everything. And we've exceeded and surpassed our targeted returns in all 6 of our funds over every single reporting period that every fund has been open, and very consistently. All right, so let me see what other questions we have here. All right, do you anticipate geographic growth throughout the U.S. In 2019-20? So thanks, John. So short answer is yes. So right now, on the lending side of our business, we're currently lending in, let me rephrase. On the lending side of our business, we are legally set up to lend in 34 states. And if we had the right opportunity, we would lend in any of those 34 states today, which are predominantly east of the Mississippi plus Texas is kind of the best way to describe it. Currently, we have loans in 21 or 22 of those states. And I think to date, we've made loans in 24 states. So I think from a lending standpoint, we'll continue to see more density and more lending in a lot of the states that we've historically done a smaller percentage in. So historically, we've been very dense in Pennsylvania, New Jersey, and Florida. And that's because that's where our offices are located. That's where we have the most market knowledge, the most relationship. That's where our salespeople are, et cetera. But, you know, we're continuing to see more lending done in Georgia, South Carolina, North Carolina, Virginia, Maryland, DC, Michigan, Illinois. So really up the East Coast and into the Midwest, and expect that to certainly continue. But we will remain, I certainly expect more than 50% of our loans will remain within Pennsylvania, New Jersey, and Florida. And we think that'll continue in 1920. As far as DLP investing equity into real estate, predominantly multifamily, we're in 10 states today. So we're in Florida, Georgia, North Carolina, South Carolina, Mississippi, Alabama, Louisiana, Pennsylvania, New Jersey, and Indiana. And I certainly wouldn't be surprised if we did a deal this year in Virginia, in Maryland, and Tennessee. Those are a few states that we've gotten close a lot of times, but haven't yet done a deal in. So I certainly think we'll do more business really up the East Coast. We're not specifically per se making a focused push to go into new states, but we think naturally as we continue to build relationships in these markets, it'll become natural for us to do deals in states close to the states we're active in right now. So hope that answers that question. Can you speak about the preferred return target relationship of 12% versus 7 to 8% return? Okay, so question is, I'm going to go back into full screen here for a second. So in our preferred return fund, we have a 7% preferred return to investors, and we have an overall return target of 12%. So the reason in that fund versus our lending fund, the gap is much smaller. Lending fund has a 10% preferred return and 11% targeted return. The reason the gap is so much larger in the preferred return equity fund is a couple reasons. First, the preferred return is on a quarterly basis. So we're reporting and distributing on a quarterly basis. Our target return on a current basis, from an income basis, from rental income, is to generate 8% distributions out to investors. In the lending fund or income and growth fund, all of the income is paid out monthly or quarterly. There's no retained earnings. There's nothing based on selling the assets later in the lending fund or income and growth fund. So in the preferred return equity fund, our goal is to distribute 8 to 9% cash on cash returns to investors as we operate the properties and bring in net operating income. And so in order for DLP to be able to essentially even earn our management fee, we have to have a hurdle at 7. So how our waterfall goes, which is we think very, very unique, is we pay out the 7% preferred return to investors first. Then DLP gets its 1.5% management fee. So if you go look at 100 other funds, I guarantee you at least 99 out of 100 funds you look at, it'll go management fee, then preferred return. Ours goes preferred return, then management fee. Because we want to make sure we're generating, as we talked about, I think the very first slide, consistent income to our investors. We want to make sure investors are getting at least a 7% return before we get to even pay our bills, before we even get a management fee, which is how we pay our bills, is the management fee. So we make sure investors get paid first, then we get our management fee. And our goal is to hit at least an 8% return net to investors after we get our management fee. So that's why the preferred return is lower there, because the rest of the returns to get to that 12% return are really, I expect we're going to generate returns into the mid-teens, but the target's 12, will come from selling the properties, of course, for a price greater than our costs. And the way we model our deals model out to hit at least a 20% overall IRR per deal. And so a lot of the returns will come when we sell the properties and we return back original capital plus the capital profits. So that's why the preferred return is a little different. In the lending fund, income and growth fund, everything's paid out. In the lending fund, we pay out 100% of the income monthly. So actually how it works is we pay out the preferred return of 10% right at the beginning of the month. Typically, I think always on the first of the month, we pay out the 10% preferred return, of course, assuming we hit the 10% preferred return, which we've always drastically exceeded. So we pay that out by the first of the month. And then we close out our books by sometime around the 8th to the 10th of the month. And then we pay out the everything earned over the preferred return, what we call EDC, to the investors, bringing the overall return to over 11% is the target. Historically, in the lending fund, we've averaged a little over 14. So that's why the structure is a little different between the two funds. Everything's paid out on a monthly basis. In lending fund and income and growth fund, we pay out the preferred return monthly, and then we pay out everything over the preferred return quarterly. So I hope that answers your question, Neil. Feel free to add anything else if I missed anything there. But I think maybe to answer the second part to your question, yes, we do expect that the preferred return equity fund will be, the preferred return equity fund will be our highest yielding fund out of any of our funds available today. There is a certain component of that that's out of our control, in that nobody knows exactly where values are going to be at 5 to 8 years from now. So we certainly believe we're investing in the right strategy that's going to do well through the next downturn. We certainly believe we're buying deals at really great prices. We're modeling the deals really conservatively, and then still adding in a layer of conservatism by structuring our deals as well in a preferred equity position, sheltering ourselves from market volatility, doing a lot of things to ensure we generate really strong returns. But there's a certain amount of volatility we can't control that the market actually does, reasonably decent. We're going to drastically exceed 12% returns. We think we're modeling on a conservative basis to where the market could be, still be able to hit over 12% net to investors. The Lending Fund Income and Growth Fund, they've been hitting, high 12s to low 13s net to investors over the last couple of years. That's what they're going to do. They're going to be in the 12s to low 13s. That's what they're going to do. We're not going to somehow hit 14 or 15 this year. It's not going to happen. But we're also not going to hit 9 or 10. They're going to be very consistent. All right, so a couple more questions here. As a member of the fund, would I have to file a separate tax return in each state you lend in? No, that's the short answer. So we give you a K-1, and no, you don't need to file a separate return for each state we're in. Is there a waterfall for the management fee also apply to the lending fund? Yes. So all of our funds are structured the same way, where they go preferred return first. So on Lending Fund Income and Growth Fund, it goes preferred return of 10%. Then we get our 1% management fee. And then it's 80-20 above that with a goal of at least 11 net to investors. So yes, all of our funds are now structured that way, where the preferred return is paid first, then we get our management fee. We've never had a period yet where we haven't earned our management fee and hit the preferred return. But if that did happen, if we didn't have our management fee, that we could not earn anything and you still get your preferred return. We think that's showing that we're putting our investors first. So great question, Alan. Let me scroll back and see if I hit all the questions here. Feel free to type any other ones while I'm looking through here. And Kyle, I don't know if we have any on Facebook, but I think I got all the ones here on Zoom.
We do have a couple here from George. It's kind of a two-parter. When you refer to at times being able to depend on rent for the payback on the purchase of an apartment complex, what time frame do you look at for the payback? And also, due to DLP's success, are there any copycats out there that can do what we're doing? What can DLP do to protect itself regarding competition?
Okay, great. So in terms of the first part of the question, in terms of income on the apartment. So when we buy a property, we're typically generating, not always, but typically generating, positive cash flow from the first month we own the property. And then as we own that property, we're coming in and we're often doing a lot of, handling a lot of neglect, a lot of exterior improvements, improving pools and clubhouses, and tackling things like roofs and siding, and landscaping is always a big one, et cetera. And then we're also typically coming in and renovating and upgrading apartments, driving up rents. Often on average, we're driving up rents about $120, $125 a month from where they're at when we buy it to where they are on units that we're renting within a year of owning it. So as we drive up rents, as we improve the physical property, we're in turn then driving up the cash flow. And so typically our deals cash flow is the weakest in year one, but then it continues to get better and better each and every year. But with that said, in every one of our equity funds, is our third one, we've hit our targeted distributions net to investors from quarter one on each fund, and we've exceeded our return targets and our preferred return minimum in each period of this fund so far. This is only this third quarter of this fund. This fund opened in Q3 of 2018, and it'll likely be open through Q3, possibly even Q4 of this year, meaning we'll be taking in capital in this fund. It owns 1,700 apartments today, roughly, and we'll likely acquire 1,500 to 2,000 more apartments in this fund this year before we close it to new investments. So I hope that answered that question. If not, feel free to elaborate further. And the second part of your question, I think, was, are there copycatters to us? So, each one of our businesses, I don't know which part you mean, but so I'll kind of tackle them each here briefly. So as a lender at Direct Lending Partners, which is if you were looking to borrow money, you would come to Direct Lending Partners. There are tons of competitors. there's never been more private lenders than there are today. There are large national institutional backed groups. There are lots of regional groups. There's lots of local mom and pop groups. There's tons of competition. So it's a highly competitive space where what we really try to sell is relationships to our investors, and then what we're selling and providing is speed, surety of execution, and a great experience, which is rare working with a lender. And then because we're an operator as well as a lender, we're able to bring them a lot of value through our knowledge, our relationships, vendors, contractors, et cetera. That really helps strengthen our relationship because they see that we can bring them a lot of value above and beyond just the loans. As far as DLP as a multifamily operator, similar answer. There's tons of multifamily operators out there today. Few that are truly vertically integrated like we are, and few that control the full capital stack, meaning the debt and the equity, and can capitalize on some of the distressed types of deals that we capitalize on. But there's tons of multifamily operators, again, more than there's ever been. As far as DLP as a fund manager providing these types of investment vehicles, yes. So there's definitely lots of multifamily fund managers out there. Some groups much larger than us out there. There's groups out there that own 50, 60, 70,000 apartments that have somewhat similar, not necessarily similar in terms of some of the structural things we do, but that are designed to buy multifamily value add Class B real estate and generate similar returns. So yes, there are other fund managers out there. Most of the fund managers out there that we come across, though, focus on taking in institutional capital. They're not bringing in high net worth individual investors like most of you. So we don't really compete against them in terms of investors such as yourself coming to us and saying, hey, I'm debating between investing in your fund or two other groups who I'm talking to doing similar things. That certainly changed a little bit with some of the crowdfunding type platforms out there that you can see some other kind of fund managers out there. But we don't really deal with it often. And I don't know any fund managers in St. Augustine, Florida that do anything like we do, or Bethlehem, Pennsylvania, the two places we're headquartered in, where a lot of our investors are located. And then on the lending side, there's a lot less actually fund managers out there offering funds like the Lending Fund. There's certainly some out there, but there's not really a lot of them out there that are offering similar types of returns. And the ones that are out there certainly aren't producing the yields that we're producing. I don't know any that are producing the yields we're producing. But there are some, a handful of funds doing somewhat similar things, producing, 9-10% type returns in other parts of the country that I know that do a good job. So I hope that answers that question. Any other questions you may have? There's no more in Zoom right now. Kyle, is any more on Facebook? I'll gladly tackle them. If not, I will wrap us up. I'll remind us of this little incentive. You can go to dlpcapitalpartners.com/promotion. Kyle, if you can drop that in the chat box again, that'd be great. And then what will happen is Larry, our senior investor success manager, Bob Shimanak, investor success manager, one of them will reach out to you, chat more about the strategies, provide you access to our investor portal, et cetera, and give you insight to see if working with us makes sense for you, or like many of you already invested with us, if allocating to one of our other funds makes sense for you. So thank you, everybody. Kyle, anything else?
We do have a couple more in the Zoom
Okay.
chat if you wanted to
Sure. Yeah,
tackle those.
Yep, and I'll wrap us up.
Yep.
All right, let me go pull back up here. Sorry, but I didn't see this. All right, so do any of the investment funds invest in opportunity zones? Yeah, that's a hot topic, and I'm actually surprised I didn't see that one yet, or I didn't hear that one earlier. So we will invest in opportunity zones for sure, but it's not. We're not opening a fund specifically focused on it. So if we can invest in a great investment that happens to be in an opportunity zone, that we can get that benefit, a tax benefit for you as an investor, being able to invest in that fund, we certainly will provide those opportunities. I certainly think that we will have a couple of those opportunities here, this year. And we will specifically try to target bringing those investment opportunities to investors who are looking to shelter some of your gains from, say, the stock market and get out of the stock market and do so in a very tax efficient way, which is the opportunity zones may be the best way ever to do that. But most of the funds out there investing in opportunity zones are in my opinion, are going to fail, because something being an opportunity zone doesn't make it a good investment. It has to be a good investment already. And the reason they created these opportunity zones is because most of the areas that are considered opportunity zones are not good investment opportunities. That's why nobody's investing there, and that's why they're offering this huge tax incentive to get you to invest there, because they're not good investments. So you have to be able to find the unique opportunities that are good investment and can provide the tax incentive. So they are out there, but of course, as you'd expect, with a huge tax incentive like these opportunity zones, I won't get deep into that on this call, but you know, a lot of capital is going after the areas that are most attractive, which will drive up prices and then make these deals not good deals in more cases than not. Next question here is, will you be increasing the returns on the bond offerings, the note offering? So good question, Tim. So no, at this time we're not increasing the fixed rates note offering. We did run an incentive over Thanksgiving, where we did about a 1 to 1.5% increase in the rates. And it's really cool. One thing I would like to mention is we were able to, through that incentive, we actually, what we did was we gave 1.5% increase in people invested in notes. And then we also gave 10,000 meals to Feeding America for every $1 million we raised. And we raised almost $4 million, and we actually ended up increasing it. We donated 50,000 foods to Feeding America. So, you know, thank you to many of you guys who invested and contributed to a pretty cool, giving event that we were able to do through that incentive. So, so we're not running that again now. Maybe we will later this year, but what we are doing right now is decreasing the minimums. So thank you, Tim. And then I think the last question I see on here is about leverage. So question is, how much leverage does the DLP Lending Fund have? And what that question means is, how much leverage does the lending fund borrow against its loans? So right now we're at the highest amount of leverage we've been at in the lending fund, which is we have about $1 of leverage for every $2.50 in equity. So $1 to every $2.50 of equity. We've been saying for the last 5 years that we really felt we'd get to about $1 of debt or leverage for every $1.25 to $1.50 equity, or 35-40% debt, 60% equity. And that's really where we think we'll be at this year, which we believe to be very modest leverage that helps us, increase our yields. It also helps us with cash flow management, honoring redemptions, etc. So thank you for that question. Let me make sure that I got them all. Kyle, you see any other ones in there?
Well, I have one here from Facebook, if you don't mind. I know we're trying to wrap up, but the person asked about if there's any dinner events coming up soon, to hear about this in person.
Yeah, I think we just posted it on our site as well, so I'll pull it up here to show everybody the exact dates. So yes, we just I think yesterday launched the next upcoming dinners. So April 4th will be the next dinner in St. Augustine, here where I'm talking to you from right now, actually literally across the street from where I'm sitting, at the Plencia Club. So that'll be April 4th. And then April 25th will be the next one in Bethlehem, which will be the first time ever we do it at the Arts Quest Center over at Steel Stacks. So excited about that. That'll be on April 25th. So Kyle just dropped that link in there as well, so you can go ahead and register if you want to come join us at one of our upcoming dinner events. So thanks for that question.
That's it for me.
All right, sounds good. Well, appreciate all the awesome questions, everybody, all the engagement. Hope everybody has an awesome rest of the day, and hopefully I'll see you at one of the upcoming events, or we do have another webinar focused on cash flow actually in a couple weeks that we'll be sending out an invite to. I think it's March 13th or 14th, so we'll get that invite out as well here shortly. So thanks, everybody.